What's up, guys? I'm Mike from StockedUp. In this video, I'm going to be showing you an options cash flow strategy. You probably never heard of this before. In this type of spread, it's unconventional and it's pretty cool though. And I'm also going to be talking about what I think for the market for the next 2 weeks. So in this example, we're going to be looking at Bank of America. So pretty much what the call out is first you have to understand the general thinking. So for Bank of America, personally, I don't think the market is going to fall out like into an all-out panic like we saw last week for the next 2 weeks. You know, is it going to be volatile? Yes. Is it going to be choppy? Yes. But I do not think we're going to see an all-out panic. Really, all these big countries, even like the Federal Reserve and Trump, and they're all doing the best that they can to ease the fears of this virus, and they have a lot of say. Like, even if they're wrong, they have a lot of say. So, like, for example, like, even if like it was bad for the Federal Reserve cut interest rates again today. That's bad for the overall economy in the long term, but it's all about pretty much what they say. Like, for example, if they say we're doing our very best to contain the virus and help offset any losses, we're going to do the best we possibly can to help U.S. companies or whatever. And Trump says we're going to find a cure, and Trump says time to buy the market. Even if they're wrong, it does have a pretty big effect on the market. So part to do with that, and another part to do with, guys, we fell 15% last week. It's one of the biggest falls in a week ever. That's a huge fall. We have to have some sort of retracement after that, but that's like the general overview. Make sure you guys watch this video to the end so I can fully explain the strategy. But like, for example, Bank of America, the stock got hit pretty hard. And let's say I think this is going to be a good buy signal. Pretty much what you could do is, let's say you want to buy a call on it. So if we go to Bank of America and we go to, let's say we go to like here. Let me check something real quick. So let's say we go to Bank of America, and we are bullish on this, right? And we're not bullish for this week, but let's say we're bullish for like the next, let's say like the next couple months. So we pick up a Bank of America call option, like the 29 strike call, right? And we see this as a great buy signal. The 29 strike call costs about $100 right now. So what you could do, Bank of America costs $100 for the 29 strike call. Obviously, you have till April for this to work. If Bank of America goes up, let's say, to let's say like $31, you would make, the option would be valued at $200 and you'd be at a $100 profit. Now, that's great if you just want to sell the option, but what you can do is, let's say at the 29 strike call that expires in April, and let's say Bank of America starts to go up. Like, let's say it goes up to like, let's say it goes up to like 30, let's say it goes up to like $30, right, by next week. Let's say, yeah, by next week it goes up to $30. Now what you can do is you could go to the chain, and you could go to like the March chain, or like the March 13th chain, or like the March 27th chain, and what you could do is, if Bank of America is at $30, that means this option right here, this 29 strike call, is at minimum going to be worth $100. It's going to be worth more than that because it has some time value in it. Let's say it's worth $120. What you can do is you could sell like the 30 strike call, and that might be worth like $80, right? That might be worth $80 or something like that. You could sell that, and if you sell it for $80, that's called a diagonal spread. And as long as Bank of America is below $30 below $30 by that expiration, you're going to keep the $90 you sold that for, and you're still going to have your Bank of America April call option that's still worth, $200 or $150 or whatever the case may be. And then you could do the same thing the next week. So you could sell like the 31 call option like for March 27th, or the $29.50 call option, or the 32 strike call option, and you could get like $80 or $60 or $50 every week off of an initial investment of $100. So pretty much what you're doing is how it works is you buy a call option, right? Let's say the 29 strike call that expires in, some time, like for example, April. As long as Bank of America goes up, all you have to do each week is sell a call option greater than 29. So for example, all you have to do each week is sell like the 30 strike call option and do that every single week. Or you can sell the 35 strike call option every single week. and you're going to get a weekly income, obviously, each week. So, it only works if Bank of America is going up. You could do it if it's going down too, but you're not going to make as much money. So the pros of doing this is you can really, really milk the initial investment you put in. So if you invest $100 here and you collect, let's say, like an average of like $60 for 1, 2, 3, 4, 5, 6 weeks. I mean, what is that? $6 times what did I say? If you collect $50 times 6 weeks, you get about $300 back worth of cash on an initial $100 investment, plus what the option is worth by the time you sell it. So that example is saying if Bank of America goes up by April, obviously if it skyrockets up, you might just make 500% on your money in a week, and it'd be more logical to sell just the initial call option you had. But guys, note that this is an advanced strategy. If Bank of America, for example, let's say you have the 29 strike call option that expires in April, and you sell like the 31 strike call option that expires on March 6th, and let's say by March 6th, let's say Bank of America is above the option you sold. Like let's say it's at let's say Bank of America is at 32. Then what's going to happen is technically you bought a debit spread, and technically you are going to be forced to sell both your options, but that's okay because you already guaranteed a profit, because when you sold that spread, you already got a high enough credit back, and then you still have it as a debit spread. So it would actually be a really good thing if you got assigned. It's a good problem to have, but I just wanted you guys to be aware of what will happen if Bank of America goes up that much. So, obviously you can lose on this still if Bank of America goes down, and this strategy is advanced. It's only recommended if you really know what you're doing in the options market. But I hope this video taught you something, or at least inspired an idea for you guys, or just taught you something about how options or spreads work. If you guys have any questions, let me know in the comments down below. But other than that, thanks for watching.